Few ideas in corporate governance have generated as much debate as the proposal to reduce or eliminate quarterly reporting requirements. Supporters argue that less frequent reporting would encourage long term thinking and reduce pressure to manage earnings. Critics counter that quarterly reporting is one of the most important tools investors and boards have for maintaining accountability, transparency, and trust. As directors consider what role disclosure should play in modern governance, an important question emerges. Is quarterly reporting really the cause of short termism, or is the issue something deeper within corporate culture and board oversight? In this segment with Charles Elson, Executive Editor at Large of Directors and Boards, we'll examine what boards, investors, and companies stand to gain or lose if the quarterly reporting model changes. Charles, if quarterly reporting requirements were reduced or eliminated, what would boards lose in terms of oversight, accountability, and investor trust? And would any meaningful governance benefits actually be gained?
No, I don't think so. Honestly, even if the requirement from the SEC is implemented and we go to 6-month periods, I don't think investors will allow it. I think they're going to continue to demand quarterly reporting, and the reason is pretty simple. Companies are judged on their quarters by their boards. The accounting profession reports numbers quarterly. Every 3 months, you get a snapshot into how the company's doing. These reports quarterly are critical for boards in evaluating management. And if you were to suddenly say it's every 6 months, boards will still get the information quarterly. They have to. The idea is, well, if it's 6-month reporting and the public gets it only every 6 months, then obviously you won't have earnings management issues, the pressure for quote unquote quarterly earnings increases, things like that. I don't believe that's true at all. I think that, frankly, if you set it to 6 months, you'll be, the same incentive to manage the numbers for the 6 months will be there that you had for the quarter. And I don't think it solves the problem. It's important for boards because, frankly, boards obviously need quarterly reporting. That's how you judge managerial performance from the board level. And if the board gets that information, I think so should the investors, and let them understand and look at the numbers too. Obviously, you can't judge a company on a quarter, but a quarter's results are relevant and they are material, and they may show a trend, they may not. That's for the board to decide. But certainly your public investors need that as well. And frankly, if you didn't and you kept silent for 6 months, ultimately you're going to lead to a lot of speculation in the stock price, probably some insider trading as well from people who really know what's going on over those 6 months. And the result is a less efficient market and no impact whatsoever on quarterly earnings or quarterly reporting or management of quarterly numbers. And in the end, I think everyone loses. It's just a bad idea, sadly.
Critics of quarterly reporting argue it fuels short-termism and earnings management. Is that truly a disclosure problem, or is it ultimately a board and management culture problem?
I think it's probably more of a oversight problem vis-a-vis the board and management. I mean, a board who allows management to manage the numbers or massage the numbers is really not doing its job. I mean, the key is honesty and transparency. And when you create a culture where there's an incentive to management to manage numbers, to quote unquote get that quick pop, that's a bad culture in the end. And frankly, this whole short-term, long-term thing is a little nonsensical in the sense that every stock price has a long-term value built into it. The idea of a value, when you come up with a price, is the future earnings of the company. And you can manipulate a quarter or two, but ultimately it always comes out in the wash. In the end, people figured it out. Now the question is, okay, let's say we get rid of quarterly reporting and do it every 6 months to quote keep long-term perspectives in place. Well, why not then say let's do it once a year? Can you really judge a company every 6 months? Maybe you do it maybe you do it every 5 years. That's long term. Maybe you have the board meet once every 5 years and look at what to do and report every 5 years. Of course, that's ridiculous. That will never happen. But I think that is the nonsensical nature of this. Oh, if we just extend the time frame, we'll create more long term thinking. I don't think it makes a lot of sense. That's long term thinking is up to the board and its stewardship of management and its oversight of management that really gets you to a long term perspective. As I said, you can't judge anything on a quarter, but a quarter does tell you something as a director. You can begin to see trends in quarters, and you have to value it as such. How the public deals with those numbers is really the public itself, the analysts themselves. The short termism, quote unquote, really has to do more, with I guess just management managing to analysts and analysts viewing it on the short. But look, the market isn't made up of analysts. It over the long period, the market does a pretty good job of evaluating performance and value. And I think it's up to the board to insist to management that you have to manage to the long term. And you may take your knocks in a quarter. That happens. But obviously, if you make the case to your board and to the public, if you will, your shareholders, that you may have had a bad quarter, but long term you're trying to create long term value, and they believe you, then ultimately it works itself out. And I think that's always the way you can look at it. At least that's how I've looked at it as a director. A bad quarter is just that, a bad quarter.
Yeah.
If you have two bad quarters and you have no decent explanation, then the bad quarter becomes a trend, and a trend becomes a real problem. That's the issue.
Boards themselves evaluate management and monitor performance on a quarterly cadence. If directors rely on quarterly financial visibility to fulfill their fiduciary duties, why shouldn't shareholders expect the same level of transparency?
Absolutely. And you got to remember the boards are elected by the shareholders. They're the shareholders' representatives, fiduciaries. And to say to someone, oh, I'm not going to tell you what's really going on because it may upset you. It's that how in the world can you run an efficient market that way? The owners have the right and expectation to understand the company's performance, as do their elected representatives. Transparency is critical to this whole thing. And if you eliminate that transparency and keep people guessing for 6 months, that leads to speculation and in swings in the stock price that are probably not helpful to the company itself. And it frankly leads to a lot of insider trading, if you think about it, because someone in the inside of that company knows, and at some point it's going to get out, and they may trade on it. A 6 month silence period doesn't make a lot of sense. Hear no evil, see no evil, speak no evil. That's not a way to run a business in a public market.